Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Elliott Holland. How you doing, Elliott?
I'm doing amazing, man. How are you?
You're always doing amazing. That's why I like talking to
Yeah,
you.
that's right. That's right.
Well, those of you who didn't remember, we had a raw episode. Ellie and I were just talking off the cuff. We didn't plan on releasing it, but it was such a good conversation that we released it and got a lot of positive feedback. So if you haven't heard it, please do. But bring Elliot on to talk again, and probably more commonly because the conversations are, from our perspective, are interesting, and so that's why we do this, and hopefully you benefit from it as well. But for those of you who haven't heard Elliot in the past, Elliot, tell us a bit about your background before we dive right in.
Sure. Yeah, I got a fancy MBA from Harvard. I worked in private equity and quickly understood that owning the equity as opposed to representing others' equity was the key to both freedom and financial wealth. So I spent the next 6 or 7 years working as an independent sponsor and other various kind of unfunded private equity instruments. Struggled a bit getting deals across the finish line. I think I didn't have enough rich uncles, honestly, Kirk. And then I had all these fancy skills that I had to figure out how to monetize. And I saw the new ecosystem of what I'll call like the fake easy money deal, and all of the people who propose that buying $1 million business with a personal guarantee is easy as eating a slice of pie. And so I started a financial due diligence business that produces an audit-like product called a quality of earnings to help save people who hear these kind of crazy tales and have the ambition to go after it, which I love, but need a conservative view on these business assets they're buying to save them from going broke and bankrupt. And then did that for 7 years. And then I added some educational products like a mastermind last year to help people who are struggling getting through the malarkey of data and understanding how you really need to operate to be successful. And so I kind of help first time buyers get over the hump of doing an amazing first deal and uh, not buying somebody else's liability.
Nice, nice. Yeah, we all need more rich uncles. You can never have
Exactly.
enough of those.
Exactly.
Um, so I'm kind of before we dive into due diligence part, I'm insanely curious about a bunch of spaces right now, which we'll talk about today. But one of them is private equity, and I know it used to be the smartest people in the room would go into private equity, and it
Yep.
was it was the way you make an insane amount of money. I mean, look at Mitt Romney, $100
Yep.
million IRA, not including all the other stuff he's done.
Yeah.
Um, you can create some crazy money, and I live in the Boston area. It's like everybody has private equity background because there's so
That's
much
right.
money floating around. But it makes me wonder because I've seen trends in the last 7 years, 10 years where uh, things aren't all that good,
That's right.
and for sure they're pushing. At least when Trump took office, I don't know if it's happened, but they're pushing to get private equity into 401(k) plans, and so I've got a lot of thoughts on this, but I'm curious on
Mm.
yours.
Yeah. You asked an amazing question I didn't see coming. So
I tend to do
I
that.
love it. So when I got out of HBS, I'm an undergrad engineer. So you guys should understand that. So I like looking at data sets, listening to what people say they mean, and actually determining on my own what the data is actually saying. What I saw 10 years ago was that the returns in private equity were barely outpacing the S&P and were not as good as mezzanine debt, which is more secure and kind of in between senior debt and private equity. And so when I'm saying someone's locking up money on an unsecured position for 10 years and getting 9%, but they can get 11% in mezzanine debt that goes into most of these private equity deals, I would have preferred to be the mezzanine debt. I think that still is true. Fast forward 10 years, I think it's worse now. What you're hearing is these continuation instruments, and they sound like, oh, well, no big deal. I got a good deal. I want to buy it again, right, Kurt? But it reminds me of Elon Musk buying Grok and setting an internal price for it that then upped his own personal net worth, but no money traded hands. And so as a finance guy, when I'm investing my money, I need to get it out so I can spend it. I call BS. So I think private equity returns are worse than they were a decade ago. Venture has come down too. And so I think what's happening is that the prestige of the industry has maintained its kind of aura despite the returns coming down. And so again, as an engineer and not a finance guy, and I would welcome the debate on this because I think I could see the other side. It's sort of like, are they still the smartest folks in the room? Because if we're capitalists and we are in the work that we do, then it's the guys getting the greatest consistent returns that are the smartest people in the room. And just because the instrument or the process you use to make money is complex and hard to get into, that doesn't define the smartest guy in the room, in my opinion. Am I tracking? Did I kind of answer?
Yeah, no, it's a complex topic because I'm a dyed-in-the-wool capitalist, always will be, and at the same time, I see private equity destroying capitalism. It's um, not the stuff you've been talking about, but all um, the other kind of things where I think back. I don't know, 20 years ago, 30 years ago, private equity is a little bit different. I think now they're trying to do whatever they can to squeeze every nickel out of a deal, which I think can be okay. But, when it destroys companies, because they basically buy the company, put a bunch of debt, and then the company doesn't survive and people lose their jobs because they all paid themselves a dividend and who cares?
That's right.
And they destroy industries because they're in there. Like I heard a podcast about the veterinary industry,
Yeah,
and the way it was described, I started to laugh because it sounds like every other industry out there, right?
right.
It was always not that expensive, and then capitalism comes in and tears it up, and now everything's expensive, right?
That's right.
Um, so, you know, that part is what it is. That's capitalism, right? It's just,
Right.
and you take it for what it is, better or worse. But the thing that I struggle with is the part of private equity that is more or less screwing over the investor. And for ultra high net worth, whatever, that's their
Right.
problem, right? If you get that much
Right.
money, you need to be smart enough with it. But when they can't find enough liquidity to get out of deals, so
Yeah.
they start to take advantage of the regular investors who want to be
There we
cool,
go.
who want to be in the cool next thing.
Right.
Um, should that be allowed? And I don't
No, but
know.
it's going to be the same thing
I
you
know.
heard about Trump opening up the 401k. You and I both knew what that meant. Let's put a more risky instrument to the benefit of my rich, wealthy friends who are the donors and the big blocks to enable them to get out of these positions. And when you say you can't find liquidity, let's be gosh darn specific. Nobody wants to pay the price that's required for you to get the return that you need to raise the next fund, which means you didn't create the value that you promised your investors. And now selling at a value that's less than what you promised your investors has an implication on your ability to sustain your business, as does trying to create some narrative to hold it, which was the hazard of having illiquid investments. Because relative to like an S&P position, if I don't like the S&P for 6 months, I can get out of it today, change my mind in a week, and get back in it the next week. Whereas if I am in ABC PE fund, particularly as part of a 401k allocation, good luck. And I think you're right. One of the things that I think prudent investors do differently, one of the things we shy away from areas where part of the return you get is in prestige. Don't pay me in prestige, Kurt. I like cash. So I don't like
Everyone else pays
sports.
cash.
I don't like entertainment. I don't like any of that. I'll do. apprenticeships and I'll work for free to get into something where there's ultimate upside. But like, I don't want some place where it's like, well, you're hanging out with athletes, so Elliot, we're gonna give you 40% less. And private equity feels that way. But here's the other thing I'll say. Sometimes when you don't understand what's going on in a micro level, I think a good way is go macro. Well, macro is there's more people chasing that prestige that's making the private equity investor network the supply of investors greater than the supply of great deals. And I know I'm talking supply and demand, but using supply twice. The number of investors outpace the number of deals, which means you and I, as competitive private equity firms, are bidding up the price of an asset to not have to give money back to investors. We're not telling anybody because it's embarrassing, but you and I know what's going on. And so we're advocating for our president or whoever, hey, let's put it in the 401k, man, because all those guys want private equity allocation that was so hard to get. But private equity allocation, if you just call it an 8% return expectation, I don't want too much of that. Not when I got to hold my money up for 10 years.
Yeah,
Illiquid 8%.
that's terrible.
I don't want that in my portfolio, really.
Yeah. It's yeah, it's interesting. I noticed in when 2022, I think it was, when interest rates started to go up, and I started to notice that I would get like 10 to 20 calls a day from these firms, these funds, venture capital, private equity, whatever, these funds saying, "Hey, I got some stuff for you." And you see the headlines where, they froze liquidations in some of these big institutional funds. And I start laughing because I know the game, like I
Okay.
never get calls, but when it's bad, I get a lot of calls. And so I'm like, great, you couldn't find anyone else to sell it to?
Yep.
Like, why are you calling me? We're not friends. You
And
know?
that's another tell. When why are you the best buyer for this asset? If it was so good, and you're right, I love Boston as an investing city. Love it. A bunch of individualistic, don't give a gosh darn about what other people are saying, sleepy rich dudes. And I worked for one and loved it. But it's like, why are you calling me? If you got thousands of rich friends, that implies that all of them passed on this. You should never get to me with the high quality asset. And that's also the separation of hubris and investor think. It's like, as great as it is to get a call from ABC Private Equity Fund, you got to sort of say, why are they're calling me because the asset sucks and they're hoping that I don't know.
Yep. Yeah, it's I remember it's 2023 or 24 when there was a big trend of selling GP stakes.
Yep.
And it's probably still going on, but I just haven't heard it lately. But it was 2023, 24, there was a big trend, and it started then. And I remember being contacted by a guy, it was actually a guy who worked for one of the guests on the show a while back. And they had GP stakes for like KKR.
Yeah.
I'm looking at this like, wow, KKR, they're like the best. And then I start, and then that was my like, my monkey brain kind of going. And then and I came to, and I'm like, so why is the head of KKR selling a GP stake? His stake in his firm, and if he knows something, why do I want to be the rube that buys it? It's like, oh, I want to buy from Warren Buffett. That's a great idea. Like it's just there's nothing smart about that, but yet we all do it because we're like, ooh, KKR, they're smart. Let's buy their stuff, and it's like, that's not a good sign.
One of the best things I remember at Harvard when I was there that made the most sense to me as an engineer was like, Elliot, when you get to a table, whether it's a gambling table or an investing table, and you're sitting across from Kurt, just make it singular. Who's better educated on the asset for sale? And if the better educated person is selling, that implies it's overvalued. And if you just follow that without doing bunches of research and all the rest, and you don't overestimate your ability in competitive marketplaces, you'd save a lot of baloney. Because if Warren Buffett's selling the same equity that made him rich for 30 years. You have to consider that his outlook on it could change today, just like my outlook on a stock could. And if it was that way, selling it to unsuspecting investors that are basically buying a piece of Warren Buffett, and so again, getting some value from the story they can tell versus the return they're likely to get, you put yourself in this weird place. It's like, am I going to go in the basketball court with Michael Jordan and be like, "Hey, man,
I
best of
can
three,"
dunk on you.
right? Nah. If I see some bloke on a pickup court, maybe I'll take my chances. But you know, KKR understands their assets better than you. That's part of the illiquidity of it. I mean, if we go back to the most basic thing, it's like when a company um starts starts buying up shares, what they're saying is we believe the value of our shares are higher than the market does, and so we're betting on it. When they sell new shares, it's something different. When the CEO, that's why the CEOs have to announce when they're selling any sizable amount of shares because it's telling. You almost have to clear the air that they're not telling you that this stock sucks. They're just trying to get liquidity that they have the right to. But these are the fundamental rules of investing that get convoluted and all this slop that's out here. And people who now take a 2-day class from a Harvard extension thing and now they're Harvard finance masters or, money managers of esteem. It's like because they never got the fundamental stuff, you got to be real careful listening to them.
Yeah,
Because here's
it's
the other thing. Remember, the tech dudes were selling GP shares too, not just the PE. Well, imagine if you had bought some of those GP tech shares in 2023. Thank you for providing liquidity for Mr. WeWork.
yep. Yep. I mean, that's the funny part. I mean, I remember back in, I don't know, it was somewhere around 2008, 2010, somewhere, maybe it was before 2008, but I remember sitting in some guy taking me out to lunch and he was a fund of funds kind of guy. That was back
Mhm.
when fund of funds was a big deal. And I remember sitting with him because he's like, "Hey, we got access to Baupost, we got access to, all these top names, Greenlight." And I was just like, "Oh, cool! Like, let me hear about this." And so
Sure.
I sat down with him, and I'm looking at it. He's got like 10 of like the best hedge funds around. I'm like, "Cool! Let me look at show me the returns." We look through them, go to the returns page, and I see like top line, all their returns is like, 20%, 15%, some crazy numbers. And
Yeah.
and then I see the investors' net returns like 2%, 3%. I'm just like, what's going on here? I was like,
Right.
why does the investor get so little? And he's like, well, it's some of the fees. I'm like, 15% in fees? Like it wasn't small. And it just highlighted because I it's not something I did, but I was curious. And I was looking at it, I'm like, wow, that's instantly obvious to me what's going on here. Like they're basically selling the sex appeal of these hedge fund managers that you need $100 million net worth and 20 million to buy in just to get
Right.
access.
Right.
And they're giving it to Joe and Susie Public. Well, of
Yeah.
course, there's a lot of hands in the pie and it doesn't go anywhere. And then people are frustrated. But Wall Street made their nut and that's all they care about. So, I think one of
And
the,
honestly, Kirk, you are their nut if you take that trade. That's what I've been dealing with. I'll spend a couple minutes in my neck of the woods. Um, so small business acquisition is kind of the new frontier in private equity, in my opinion. But the returns aren't known because what they're saying is that funded search funds that Stanford puts a report out on annually, people are assuming that self-funded have the same 33% returns. Well, as an engineer, I'm like, that data's not out yet because you'd have to actually go vintage year, just like private equity, and say what deals were done in 2015 or 2018 that have now been realized and what are the returns on those, and we don't know. Well, now what's happening is the frenzy of buyers relative to the number of good deals has created environments where people are falsifying 100% of the profits of these small businesses to unsuspecting buyers. And it turns into a bit of a Ponzi scheme, Kurt, which is a heavy word. yell at me if you want, but I think sometimes you got to put the imagery in people's minds to understand what's going on. It's like, well, if you liquidate Mr. KKR, he just made a return off of your foolishness versus the profits of his investment. And you're right. He probably already got his return. He's just trying to find someone to take the short end of that trade. And as a master of the universe, one of the places to go offload it is with unsuspecting people who like the sexiness of holding the asset, who don't know. But I think the reason that's so important, I think, in this podcast is we're talking to people who need to know, who need to go back to the fundamental precepts of investing. You shouldn't be going up against Warren Buffett on a trade.
He's 30, 40% cash. Good luck to you.
Warren's gonna kick both of our butts and ChatGPT on a bad day, right? These people, and that's something else I think that you and I know from being close to some of the leaders of these funds. These guys have spent 20 and 30 years spending 80 to 100 hours a week on being the best investor in a very narrow asset class. If they're trying to sell it to you, please don't go hubris first and think that that's a good trade for you.
Yeah, it's kind of like these people that invest in movies because they want their name in lights, knowing full
Sure,
well that it's just basically lighting money on fire.
sure,
Just ego. And unfortunately, that's what finance is in a lot of ways. It's ego, and it's not always deliberate. It's not like like, oh, I'm arrogant. It's just human nature in many ways. You did mention search funds, and I know what they are, but you want to maybe mention the listeners what
right.
that's about, and maybe we can talk a little bit about the trend there because I've heard about them a while ago, but I don't hear much about them. It's kind of this under the surface thing that people don't even rarely even use the word.
Sure.
But maybe we can talk a little bit about those.
Thank you for the opportunity. So, private equity is buying large businesses. Should I just say it in plain language? Typically, the low end of private equity is a business with $3 to $5 million of EBITDA or cash flow. That's kind of the bottom of private equity, meaning under $3 to $5 million of EBITDA has been the wild, wild west. In fact, when I was leaving HBS in 2011, the nomenclature was don't even try to buy those things. There's no profit in it. Well, as markets become more mature, what do people test? Well, are you sure? And so search funds are actually the baby of venture capital and private equity. And I want to say that because I think it helps with like the genesis of it. It started in Silicon Valley because those are VC guys. And they said, how do we put a VC model on private equity? Well, 20 of them got together and they said, look, why don't we invest in 20 or 30 MBAs fresh out of the top 3 to 5 schools who will go buy a 1 million EBITDA, $2 million EBITDA business in a very similar structure to private equity. But instead of there being a management team, this young entrepreneur would go run the business as the new CEO. And so that became a search fund. And the way it worked is Elliott coming out of business school would say, hey, search fund guys, I need $200,000 a year to fund my salary and diligence expenses. I need that for 2 years. Investors say, okay, here's 400 grand, but we're going to get a 50% step up on your deal once you find it. So we're paying you to go find a deal. If you find it, we're going to invest in it. And if you don't, no recourse. We won't do it again, but you know, you don't owe us back the money. And those deals did very well and still are on the funded side. Stanford puts out a report every year. You can Google it, Stanford Search Fund Report. And they've been doing about 30 to 35% IRR for 10, 15 years. And so a search fund is typically a young MBA buying a business using a set of 20 or 30 investors, typically out of Silicon Valley. And it's a mini private equity deal where the entrepreneur becomes the CEO. What's shown up in the past 5 to 10 years have been self-funded search fund. And I think if Stanford is the funded search fund mecca, Harvard is the self-funded mecca. Not that they don't do a little bit of each, but I think that holds true. And what that means is there's a government loan product called the SBA 7A loan, where any U.S. citizen can get up to $5 million of debt. It's personally guaranteed debt to go fund their own deal. And so instead of getting money from others, you can just use your own savings to fund your living expenses and diligence expenses. And you can go use this SBA 7A loan product to buy a business. Typically, those businesses are under $5 million in purchase price, which means they're $300,000 to just over $1 million in EBITDA. And so when I talk about search funds, now there's funded, think Stanford, self-funded, think Harvard, and they are essentially, Kurt, here's a good analogy for those who maybe have couple of gray hairs like us, right? In the 80s, like Drexel and those guys was throwing money at LBOs like there was no tomorrow. Well, it's very similar to right now in the search fund world where people are throwing cash at these deals, facing what they believe is a 33% return. There's a lot of caveats to that, but hopefully that explained the search fund environment. If I missed something that a person from your audience should hear, push me.
No, no, this is good. It's a good start because I think the challenge is, and I haven't really been able to find any guests to talk about search funds because it's such a small emerging niche, and I've always found it fascinating. I originally heard about it like 15 years ago. I was talking to an attorney, and he kind of talked about it in Boston. He's like, "Yeah, we got like 6 or 7 of us attorneys. We pool 100K a piece or whatever it was, and we go hire an MBA out of Harvard and replace guy retires and we go replace him and run the business." And I was like,
That's it.
that's an awesome idea. Like, how do I get it on that? He's like, it's there was like one in Boston. It was just weird. You couldn't find him, and I think things have a little changed a little bit, but I found things like that fascinating because if I'm one area of private equity that I actually like are like the roll ups. I like it.
Hmm.
It's a love hate relationship because I like the idea of it as long as it's done fairly and it tends to kind of destroy some industries in a way and raise prices and hollow it out. I think the crafts, what was it? There's like 3 craft stores and there's like 2 of them are in that process and probably private equity to destroy them. There'll be one left. I forget which one it is. Joanne's or something's probably gonna be the one left. But anyway, so you see stuff like that and you're like, okay, it's interesting, right? It's
Right.
where are the opportunities? And so I see some of these areas that are ripe for opportunities. One of them is accounting, actually,
Yes.
which I know a lot about the accounting industry. A lot of people have tried and have failed horribly at
Yes.
doing it well. And so I'm curious. I don't know if you know much about the accounting industry, but I'm curious in why they were able to make it work in some industries and not in others.
Typically, the way it works in the most efficient way is private equity starts with the signal of we want to buy $5 million to $20 million accounting companies. That's our new thing. A couple of years ago, they started pushing out home services as similar to utility. They said, well, look, if you're getting your grass cut every week, it's no different than your electricity. And so private equity starts buying the big ones. Well, little old Elliott's like, well, shoot, KKR is buying big accounting companies. Why don't I put one together? So now even the smaller private equity guys are buying, the 1 million, 2 million, getting it to 3 million, 4 million, and selling it to private equity. Well, now the everyday Joe and Susie's are like, well, shoot, I should do a self-funded, buy a $600,000 EBITDA, buy 2 or 3 others, get it to 1 or 2, and sell it to the small private equity firms and sell it to the big ones. And so I think the big private equity firms set the signal and the demand for the industries where this is more likely to work. Because keep in mind, the concept of a roll up is that you 80% wanted to sell it to a bigger shark because you can do it sooner. If you actually have to make money off of cash flow, you've levered up so many times, it may take you 10 years to pay down the debt and be able to sell at a place where it makes sense. So you're actually hoping a bigger fish buys it. So that's where the roll up works. Where I think it fails is if in 2023 I start doing a home service roll up. I finish it today and private equity is still buying home services, but let's just say something happens and next year they stop. Well, that's one way that it doesn't work. Another way is that Spreadsheet guys can get into trouble trusting the spreadsheet too much. And so what's been kind of said is you take one thing, you put it with another thing, and instead of two, you get three or
Yeah.
2.5, right? Well, the issue is somebody has to do the work of integrating those systems, those leadership teams, those marketing messages, those geographic footprints. And sometimes the reason why the roll up hasn't been done before is because it's way harder than people think. And it's kind of like when people want to disaggregate the bartender at the bar, and you don't realize that's not just a drink machine, but a confidant, a person to talk to the lonely, a bounce passer for singles bars. And so the spreadsheet says just put a machine there, but that's not the full function. I think the other thing that happens is that some people, back to this Boston concept of the individual investor, will just say, hey, you know what? Accounting companies, a lot of the bookkeeping ones are going to be benefiting hugely from a cost reduction related to artificial intelligence. And so before big private equity starts buying, if I can buy something that's operating at a 25% margin, and I think in 5 years it can be operating at a 40% margin, why don't I benefit from another trend that's happening somewhere else that's going to benefit my cost structure? And then that way it speeds up my process because I can either sell it to a bigger PE fish, or if I double the margin percentage, I can just cash flow the thing out. I think those are ways that it both works and doesn't work. If you get caught up when it's administratively more difficult, if you get caught up and don't realize how important some of the inefficiencies are to keeping value, if you time it incorrectly, that's how you can fail. If you make if you make an asset that started small more attractive for a bigger buyer, like if you started a million in EBITDA and all of a sudden Mr. KKR is interested, and that's an extreme. He's got big pockets and he's willing to pay.
So, what's your when you kind of think about these different kind of models, like what's your preference? Do you like roll-ups? Do you like people growing for cash flow, or like what's how should people be thinking about that?
So I'm going to get real granular here, but I've been in small deals for 16 years, and I think this will benefit everyone listening. I think if you're first generation, you're trying to get rich for the first time, do something that cash flows that doesn't need a whole bunch more debt because you can just never guarantee that you can get it, and you can never guarantee you can sell it at a place where it makes sense. And so it's safer to buy one asset that you can grow, that can cash flow, that you can always sell to a bigger fish, but you don't need two or three more deals, aka a roll up, to win. I think if you're starting, don't come from cash, like you don't have enough rich uncles kind of thing, Kurt. I think I like that better for that person. If you are already established and you're thinking, well, do I go work at Google or Goldman Sachs, or am I, going to take some hedge fund job, or am I going to try my hand at mini PE? I think a roll up makes more sense for that person because they're not betting their very first dollar and first opportunity with wealth in this. They're kind of saying, relative to other ways I can make a lot of money, if this hits, I can make goo gobs of money. There's not a high probability. So when roll-ups don't work, what I'm really saying is the big fish didn't come by and buy it. Those people still make a lot of money, just not as much as they would have if they've been able to sell to a bigger private equity firm. So I think for more established investors, or frankly, a lot of second generation, like your parents ran a company for 30 years, the child has a better platform. I think it almost makes sense for the parent to enable the child, frankly, to get into this and do a roll up because you can probably invest in your kids' thing. Or you don't have to do 100%, but if you're the lead investor, it makes it easier for those 10 lawyers in Boston to get comfortable with it. So I like them both for different investors, frankly, is I think how I'd answer that.
Okay. What what's your feeling on liquidity? You mentioned earlier that the returns on illiquidity are insultingly low right now. What's your feeling on what makes it worth? What makes it worth to consider an illiquidity premium?
The way I think about it is, do you have many ways to win such that, um, so the way I think about liquidity is that if I bet on something having one kind of outcome to win, I can sort of manage and maneuver and keep my eye on that one outcome. And if I think that that outcome is less likely, I can say, hey, I want to sell my stake in Coca-Cola or whatever, right? With illiquid assets, I think the way to consider it is, are there five ways to win such that I don't necessarily need to track one, but I think this is generally going in a highly positive direction with many options of getting liquidity later, such that I'm not as concerned. I'll use two examples, one real estate, one operating company to drive it home. If I buy a single family house in an area with one of the best schools in the state, I'm going to win. Rent, property appreciation. Um, it's hard to get those places. They don't trade as often. So I can cash flow, I can sell. I got plenty of ways to win. I'm not too concerned about getting into a place where the interest rate's a little bit higher. I'm going to win on that asset. I think in business, if you're like, hey, this asset cash flows, they're going to try to do a roll up. It's also an industry I think is going to benefit from cost reduction through AI. And I think the operators that are actually doing the work are smart and or experienced. Okay, now I can sit with um, a lack of liquidity because I've got three or four ways to win. If only one of those things were true, smart operators but not experienced, experienced and maybe not the smartest, or an industry I like but didn't think about there being cost savings, then I'd be less likely to want to be illiquid.
I know you're more on the a micro level than the macro level, but given that markets across the board are very expensive, how would you recommend people look at an environment like this, investing in illiquid assets? It's been one of my fears, and to be fair, it's been a fear of mine for the last 10 years, so it's
Sure.
nothing new. But at the same time, I'm fearful of the fact that at some point we hit a not we're at record valuation levels in public markets, and at some point that turns. It doesn't just go to the sky forever. How do how would you suggest people think about that when they're looking at illiquid assets?
I think diversification, and you're right, I'm more micro than macro, so this is my opinion. I think when liquid investments trade at a premium, you have to believe in them more. And so, in an environment where liquid assets are not trading at a premium, where the market's probably more balanced, then I might just say, hey, put most of your stuff in, a balanced portfolio of public stocks, and play a little bit with 5 or 10% on the side, and you'll be fine. If the public market stuff is expensive, the liquid stuff is expensive, I would think maybe you want to spend a bit more time investigating a few illiquid assets that may be good balances, diversification, um, asymmetric bets that you're comfortable with in the time horizon you'll have to hold them. Because a liquid can be 2 years, 10 years, you don't know. Um, but that's the way I'm thinking about things right now. If the assets that give you the best liquidity cost too much, are there pockets where other good investments cost relatively less because of illiquidity premiums that you think may resolve on the same day that there may be a market correction? That's how I'd broadly be thinking about it. But I'm actually curious because you've been doing it for 10 years. How do you think about it?
So, one of the areas that we specialize in the firm is alternative assets held in retirement accounts. So, we're the only advisor I know of that does this that you could actually find. There's two or three others, but they don't want the business. But virtually nobody knows how to do this. And we're experts in the self-directed IRA part, right? Is the individual assets. There's so many different areas. We're not an expert in everything, but the concept of doing it is something that we specialize in. And there was a time where you could find really good deals. And if I look back and I think about all the opportunities over the years, some of them are laughable. But I remember in 2000 and I think it was 2010. I think it was somewhere around there.
Hmm.
We were driving around Miami, and my father-in-law had a condo in Key Biscayne at the time, and so we were driving around Miami, and we saw all these cranes, just nothing happening. Cranes up, buildings empty, driving through Miami at night and seeing these, whatever, 50-story buildings with one light on,
Yeah.
right? And I remember back then the opportunities were endless and at the time I was looking into because I was very interested in tax liens because it's a
Hmm.
fantastic asset class if you know anything about it. Prior to I think 2011, it was a great asset class. After that, the returns are peanuts and it's not worth it. But it's one of the best assets because it's a priority lien against everything else. So you're getting
Yep.
paid first, except for the IRS. And but secondary to that is actually condo liens. And so if the condo building allows it, then a condo lien will allow you to do the same thing. And so I was looking at this building thinking, there's a lot of condo liens in there. I wonder if they have it in the documents that I could just go and acquire all these units and then basically acquire all the condo liens and then just acquire the units for pennies on the dollar
Right.
because people weren't paying their stuff. And I was thinking, if I only had a bag of cash right now, and this is back when we were starting our firm, so we
Yep.
didn't have a bag of cash,
Right.
like
Right.
our clients were fine, but we didn't have as much as we do now. And so in hindsight, that would have been a great opportunity. Um, Also, I remember, finding people coming to us saying, "Hey, I've got this non-traded REIT. I can't get out of it. They've locked me up." And so I did a little research and I found a marketplace that was buying and selling these things, and a lot of them were trading for like 5 cents on the dollar. And I was like, "Oh," it was just my mouth was watering. I'm like, "Oh my God." And, nobody wanted real estate, but I was looking at that and it's like, "Ooh, if I was only prepared for this, I
Right.
would have." Done more of that
Hmm.
because there were really good and there were some assets that were clearly probably valued at 2 cents on the dollar, but there were some non-traded REITs. Because I was well aware of those before the crash, and so I did
Right.
a lot of research on those because people were asking. And there were some companies that did a really good job, and there were some companies that were basically milking investors, saying we just want the annual revenue stream. They said, "Oh, we'll sell it in 5 years," but you could tell they were never going to sell it. And
Yeah.
so you could tell, and some of these things were trading at really deep discounts, and people didn't care. They would pay any amount. And I was like, this is an opportunity.
Right.
Now, you fast forward to, today or even 10 years ago, it's hard to find any assets.
Yeah.
It's, we used to, I mean, we never had enough cash in the good times, quote unquote, the good times, when assets are cheap. But now everyone's got assets and there's nothing to invest in. And people are like, well, give me something. I'm like, honestly, I don't have anything for you. I'd love to sell you something, but it's
Sure.
not the right thing for you. So I've struggled and we know certain areas very well. Private mortgages, we know very well. Um, real estate, we know very well. And
Hmm.
people come to us for these things. I'm like, I wish we had more. Like,
Yeah.
I don't want to oversell this. Like, look, if if you're interested, there will be a time where things will get better, and I will happily call you. But
Yep.
right now, it's one of those times where most of my clients are in public markets because they're liquid and I
Yep.
can get in and out and I can actively manage risk with options and other things like that, which I can't do on the private side. And so that's really been my my pathway until things get ugly again, and then there's opportunities. But I think it's very difficult. I
I think that's right.
wonder, I wonder if we will see those times again. And I don't mean this time's different. I mean the amount of liquidity in the system. I wonder if we'll see those times again.
I echo that question. I also think about so being a former private equity guy, of course, I love the Warren Buffetts and the Steve Schwartzmans at Blackstone and Leon Black at Apollo, minus the headlines and stuff. But I also have enjoyed the writings of Howard Marks, who's a debt investor and writes about risk and in an engineering way that kind of scratches my super nerd thing. And it helps me also send to my engineering friends about the risk of not taking risks. And so when I think about those two investors, they get rich in different market cycles. And so I think a lot about, and even like if you put Buffett in there, he does too. Most of the core private equity guys are trying to buy something at a fair or slightly inflated price, do financial engineering, do some operational stuff, and hope somebody bigger likes the fact that they beat some of the risk out of it, which ain't a bad thing. Warren's like, I want to sit on cash when markets are tumultuous and wait for mispriced assets where people know I sit on cash in times like this and I can get tremendous deals. And my investors trust me enough that that doesn't have to happen every 6 months. And so he sort of earned the ability to pick his shots. Well, as an individual investor, your shareholders are very limited too. So you can pick your shots. And so I think being patient enough in these tumultuous times, you throw on the tariffs, you throw on the presidential stuff, you throw on global macro stuff, you throw on all of these things, AI, you might just want to listen to Kurt and be patient because the stuff that he's got now may pale in comparison to what shows up in those industries that you know really well that may be a new instrument, like the search funds of mortgages, right? Somebody figures out something. And what I do like about times like this where there's not a lot of great places to put assets, there are people who are on their whiteboard trying to figure out how do I put some stuff together that still creates a return in a new way. And granted, new investment types have their own risks, but sometimes at the beginning they're so obvious to your point. 300 units in this Miami condo, one light on. I'll buy some condo liens. Back to my concept of illiquid or more complicated investments. If you have many ways to get rich, and one of those many ways is if I'm buying for 2 to 5 cents on the dollar, I don't have to be right often to make the whole portfolio. I think you sit and you be patient and you thank God that you have some assets that you can throw around. Um, and almost be thankful that you don't have to be super execution oriented in January 2026. You just have to be prudent and patient, which is hard for a lot of people to do. So by the time these things come up, some of the people who may be in some of the positions you want may need to get out of them because they weren't as patient and prudent.
Yeah, yeah, I agree with that sentiment. I think that's kind of a wise perspective. Yeah, it's funny because Warren Buffett, um, certainly in the last 15 years, I think, has done less well than he did in his prior
Yes.
decades. But you're right. I mean, he's 30, 40% in cash right now for a reason. And he gets these sweetheart deals. But on the other hand, he also talks about how if he only had 100 million to invest, he'd be getting 50% returns a year. I'm not sure if I believe that necessarily in this environment, but I do agree with the sentiments that if you're smaller, because he's too big, he's got to invest in
Yes.
big deals, right?
If
He
you're
can't,
smaller, you can find it.
yeah.
It doesn't scale.
You can weave around, you can find sweetheart deals that if you're patient enough, you can find these great opportunities. Whereas he he can't, if he was to buy a company, he's got to buy the whole thing. I mean, he just bought Google. Like he's probably got like 50 companies he can buy, like
Yes,
so it's
exactly.
unless he's doing his financial crisis, preferreds deals and he was doing with Goldman and a few other company and Bank of America. I mean, good on him. He's a,
Yeah.
he's a shark among shark, but
I
um
think that's the opportunity as well, Kurt, because I think my critique on Warren, and he'd slam me if he was on the podcast, but I think if we were having beer somewhere, he'd probably admit it. The kind of investing he does requires you to be, I think, a younger man, to be in the flow a bit more, to be not so close to the end of your investing life where a 15, 20-year trend isn't useful to you, or learning a whole new generation of technology or thinking. I think he was honest, and I've been to a couple of his annual meetings, and they were a blast because all the New York and San Francisco guys fly out and get berated for 2 days by Warren and Charlie, and then fly their asses back home. And it's like a volunteer flogging. If you haven't had the chance to, oh, it's amazing. In Omaha, there's no Ritz Carlton out there, man. You're gonna get what you can get, right? But it's like if you in the past 10 years, if you weren't an expert in FANG technology or now AI, some of the better opportunities weren't available to you. And I think a person of his ilk gave up on that 20 years ago. So now what that means is there's a 25-year-old Warren Buffett out there somewhere, or Robert Smith, that's getting all the data to have a point of view on some of the stuff that we don't understand yet, that is going to do a similar play to what Warren did, that's younger, more tech enabled, more global talent oriented. And so part of me actually gets excited when guys like Warren are transitioning because it opens it up, right? Because I mean, even him, and then again, I'm not the biggest expert, but my understanding is the bulk of his money was made after his 30s and 40s. So
yeah.
we look at this, older dude like, oh man, look at his brilliant behind. But he had like 15, 20 years of screwing up or not making any money to formulate these ideas. And somebody else is trying to make that Warren Buffett money. I promise you, somebody sitting with a whiteboard, a small bag of money trying to make it big, who's looking at all this stuff, leveraging AI that we couldn't leverage a decade ago in the same ways, picking up on correlated trends, probably with some coders in his investment firm. So I kind of get excited, Kurt, because I'm just like, when you have capital to invest, young, poor, smart guys need it to grow their thing. And if you sit around and you're patient enough and keep your eyes open enough, work with the right advisors like Kirk that has an ability to put um, you know, non just public liquid assets in a more stable portfolio, you're gonna win. This is one of these situations where it's like I can sort of see things brewing. It's just like right now, I can't tell you 10 things to go put your money in, but we've had other times in markets where we felt this way. We just had to wait.
Let me ask you, because you mentioned AI or machine learning,
Right, exactly.
aka. And how are you using AI? Because I know you and I talked about this on the Raw episode and a little bit, but I'm skeptical about the direction of AI. I think we're plateauing for the foreseeable future in terms of its use. But what are you seeing for use cases? Do you think it's valuable in your course of daily work? Can investors be, can business owners be using this? Like, what do you think the value is?
Sure.
I know I threw five questions at you.
No, I love it. And I'm like, the engineer in me is like, don't just run your mouth like the finance guy. Sometimes like get your thoughts together. And
It's
I'm
my
I'm
job.
hitting myself as I'm hitting others. Here's how I've generally been using it. I think you have to get in the game to be relevant. I remember my dad, who was born in 1933. when I was 10 was taking word perfect classes at the local community college because he didn't want to let computer technology pass him by. He had made a whole lot of money by then, but he was still taking community college classes. I think the first thing is get in there and try something. So what do you try? I think the first thing that you can try inside of AI for any of us, particularly white glove service folks, whether you're inside a job or working for yourself, is messaging. I think AI is amazing once you trained it with a couple of, not a couple, with a decent volume of your best writing or writing you like, taking ideas that I may have gotten 70% of the punch in 200 words. I'm able to get like 95% of the punch in those same 200 words through iterations through AI. The second thing is there's a lot of disparate data sets that our businesses have created that were hard to analyze because you need two or three analysts that you didn't want to pay and didn't want to train and didn't want to fill in the blank. Not all of that stuff. So don't try two or three things, not land and be upset. Just think about that as the investment to get good. A lot of times I'll put like my HubSpot data with some other marketing data with some messaging data and say, hey, how do I think about this given that? And they'll point me not all the way to the perfect answer, but like directionally there. What's something else I'm using it for? Research. So I think in any kind of white glove service, whether corporate or entrepreneurial, whether you're researching your client, the industry, new trends, whatever, it used to be you on a weekend and a whole bunch of reading crap to get three or four things that you believe that you thought were sustainable. Well, now you could put up ChatGPT, Claude, Grok, Gemini, all have them have deep research on the same topic as a smart person compare and contrast and have. I remember back in 2007, the partners were like, hey, do a research on clinical trials businesses in the Northeast. And I wanted on my desk by Monday morning. Well, shoot, I can do that in 20 minutes now, right? Um, I think you start there. And what I'll tell you is if you start there and if you try to get into AI two or three times a week, what you'll find is you'll be thinking about, gosh, man, I got this big project I got to do. And it's going to take a bunch of time. And you'll be like, I wonder how close ChatGPT can get me. And I think you'll be amazed. And so when I see that happening, I get excited. Now, here's the caveat. Some people will get into AI or a machine learning tool. They will ask a question and the AI will shoot out an incorrect answer and they'll be like, I'm done with this. I can't trust it. I think that's not how we've dealt with any other technology historically. And I think it's not the way to deal with this. I think you have to realize that for what AI won't do is tell you, I don't know, or I'm guessing. And so you have to sort of recognize that just like an employee might not tell you, they might, this machine learning may not. But that doesn't mean that that employee isn't worth three times the $50,000 you're paying. That's how I think about it, and that's how I'm using it.
Yeah, that's reasonable. I do. I mean, you said, I will point out one thing. I mean, you said that, no other technology have we done this, but I think all the other technologies come up with are accurate. Like spreadsheets are accurate, right? Word is accurate. I think the thing that people struggle with is the I think what people struggle with is it's more complicated, but it, I've, AI is one of those things I put a lot of thought into, and
Yeah,
I'm working my way through my on not understanding, but my macro thinking around AI. And I think one of the challenges is, we as people, we see a spreadsheet, we put numbers, we want the answer, right? We
yeah,
do something and we get the answer. And we know the process we have to go through to do that thing. I have to put
yeah,
together this spreadsheet in this way to get this result. I need
yeah,
to do A, B, C, and D to get a result. With AI, it's um, not always reliable, right?
yeah,
And our thought process around AI is, hey, I want you to do research on this thing,
yeah,
but you yourself don't know about this thing. So you're relying on the thing to do the research, which you haven't put your brain through the process to understand the thing. So you don't
Yeah.
know if it's right or wrong. So the
Yes.
fear is that we're removing the the thinking around the thing from ourselves and putting it onto this other thing, which means you didn't learn it, which means you don't understand it. So whether it's right or wrong, you're not even going to know. You have no
Yeah.
context because you haven't put the hard work in yourself. Now, if you write a paper and you ask it to edit it, okay, you did the work, right?
Right.
But if it's doing the work, this is the thing I struggle with. If I have it do the initial work, well, I didn't do the initial work, so my brain didn't have to go through the hard work of putting all the threads together of how things
Correct.
operate. And I'm just taking what it gave me and I'm like, oh, okay, I guess it's okay because I have no idea how all the threads fit together. I think that's one of the challenges with AI that people have, and people aren't really talking about this. People talk about how AI is making them dumber. Um, I'm not sure if it's making people dumber. I think it's removing the essential part that makes you smarter. It's not making you dumber. It's
Yeah.
just removing the part that does make you smarter and does make you
Which
capable.
in aggregate effectively does the same thing.
Yeah.
Let me flip it on its head a little bit as like a engineer, because you're right. The spreadsheet, you put the numbers in, it does it. Microsoft Word, you type, you get a report. Um, a lot of technology is like that. But like there's also some technology like Google Analytics that's incredibly robust and detailed, but it's almost gosh damn near impossible to get any true insights out of. So is it accurate? I think so. Useful, not so much. So then if I go one step further on the experimental side, I think about people who are doing scientific experiments where the answer to their current experiment won't cure cancer, but it might solve one little piece of that puzzle that makes solving or curing cancer easier. And they're going to put their piece with Kurt's piece, with Elliott's piece, and they're all going to be incomplete and probably inaccurate because they're going to use today's mathematical and physical understanding of things to try to say something is true. And then in 5 or 10 years, there may be new kinds of mathematics or physical understandings that are going to push it forward. And so where I'm trying to push is the imperfect experiment with an imperfect and incomplete conclusion today isn't useless. It's kind of the only way you get to the down the road thing that's useful. And I think kind of back to the investor patience, my point of view is where I'm kicking people's butts is having more patience with the imperfections of the technology while I learn it. And now my colleagues who have given up on it or don't use it, I'm like, you're turning into my dad if you didn't take the word perfect classes when I was 10.
Yeah.
And I don't think you want to be there. Um, and even more so, I think, I'm in my 40s. I sure don't want some 25-year-old to usurp me in 5 years because they're able to use this technology and some Elliott level block of data that they can run through their system and me not be able to compete. Because I think I was talking to one of my guys in my industry. He's like 20 years older than me, and we go back and forth sometimes. We love each other, but just different generations, we feel about things differently. And one of the things he was talking about is I'm scared of people using AI in the same way you said, not being smart, not creating it. Their whole concept is AI created. They're not smart. And I was like, yeah, I get that. But as I thought about it more, I don't think a 22-year-old with the best AI technology can kick your butt at understanding market. I think there's a prudence. I think there's a communication. I think there's a seeing patterns. I think there's a muscle memory. I think that you, with the same AI tool, will kick a younger person's butt because you'll be able to jump through the synapses and see things at a macro and micro level. Be able to compare it to 2008, 2023, that time right around Miami. And so where I think people are really going to crush it is like, I'm smart and I have this tool that I know is imperfect. I'll end it with this, at least this thought. Like, I think of AI as like a book summary, and I use this on our riff. It's like, look, I love How to Win Friends and Influence People. Now that I've read it 5, 10 times, I can go read the book summary and be like, okay, let me refresh my mind on what's in it today. But you'll never kick my butt in business reading the book summary, and I've read the book and practiced it for 20 years. And so I think in my mind, we may need to change the way we think about how this technology is used, because a lot of times it only gets me 80% of the way. And I end up being the 20% that allows me to sell the service to my client, which is also my competitive advantage because my competitors can't do that last 20.
Yeah. No, I think that's a wise perspective. Yeah, I mean, it's funny. Yeah, it's a good perspective is the thing about this. Um, me with AI can beat a 25-year-old with AI. Totally agree. And I, I always hesitate to reflect my experience on everyone else. I tend to be very a lot of my sense or intuition or gut tends to center around the experiences I've been through things like this, right? I can read all I want about the 87 crash or the 70s or all these things. I didn't experience them, right? I was
That's right.
alive, but not
In the
professionally.
markets. Yeah,
Yeah. So, but I was around during the 90s. I remember that vividly. I remember 2008 vividly. I remember the experience of what I went through versus every other advisor out there who was crying because their assets dropped 58%.
that's right.
And we were in cash. We missed it. And I don't say that to brag. A lot of it was luck because I knew some people who kind of clued me in on what was going on. But the point being is like, I experienced that from a different lens. And you know, a lot of my gut is based on the experience of marketplace activity, group emotions, and how things work. I can't necessarily put that into numbers or analytics. It's just a gut feel you have, like you said, when you do something long enough. But the question I have is, how do you get to that place if you're using AI, right? If you're relying on AI to do all the stuff and you're not having the same mistakes because you made a judgment call rather than like, well, AI told me to do it. Like, are we creating a situation where we don't have that same experiential learning? And I'm not saying it is or it isn't. I'm just curious in your thoughts if that's going to change people's experiential learning so they don't have that same wisdom in the same way.
So I'll use two analogies that we're living through now. One is now you can go on your phone and Google anything. So now experts that have spent 20, 30 years in science or archaeology or cancer, you and I on our phone can go, get an AI summary of their 20 years of research and have a point of view on something in 5 minutes, which is super useful in some ways, but um, I think kills people's motivation to do the work to be the next person that creates the next 20 years of stuff that's really going to push the agenda forward. So one analogy, another one, I remember I had a business partner that was 20 years older than me that would not allow me to email basically anything. He's like, you're dealing with business owners that are in their 60s. These guys want you to show up or call them. I'm not going to allow you to email. Oh, come on. Email, I could just type it and send it. It's more efficient. It's like, no, you're going to get your behind on the phone and call. I didn't like it then, but I understood what he was saying. It's that experiential thing of that 60-year-old running game on you and not even realizing how many ways he flipped you in that 2-minute phone call, almost like you're losing a wrestling match. And you're like, I got my butt kicked. I got to get better. But now, if I have to call somebody, which I do quite a bit in my line of work, and sometimes there's some tension, right? I'm doing financial due diligence. I'm a professional BS caller, frankly. I know I'm kicking 99.9% of people's butt on the phone. And I know the phone engenders more trust, a deeper level of communication, a respect level, even if I win the discussion or somebody, they respect that I actually had to, to call them. So I think you're right. I, I don't have children, so I don't have to be concerned about it in the same way, but I do worry about how this technology hinders the brains of certain people who don't have to go through certain things experientially. At the same time, I think it creates competitive advantage for guys like us who did. So now somebody can Google 2008, but I remember being at Accenture when instead of doing a 40% layoff, they laid off 10 to 15% of people every 4 to 6 weeks for 6 months. And I had 10 friends walking up to me on Fridays for 6 months saying, "Hey, Elliot, I'm out of here, man." And being like, gosh darn, guys, why aren't you just doing a one fell swoop? As an owner, I understand why not, but you lived through it and now it's like it's different. So I fear for the next generation, but I'm actually zoning in, and I've had this conversation with a lot of people. We started this conversation today. How do I know how to trust a person based on the ability in one afternoon to create like 10 books of crap based on crap? And I think you had the 7 layer thing. I said 10. I think it's just multiple layers. Like, hey man, tell me about 2008 and how your investment business made it through that. If you can't last more than 2 or 3 minutes in a like this call without a bunch of, it's like you didn't really know it like that.
Right. Yeah, it's yeah, you know, things like yeah, I mean I think one of the biggest concerns I have is more frankly societal is, you know, when I grew up and you made mistakes, you know, you learn from them and you didn't make them again, or you did and you just got better at hiding them. You know, like, you know, we all did stupid stuff, and you just get better at not getting caught as a kid. But like now, kids do stupid stuff and it's permanent. You know, social media. It's the thing I worry about, I think, is the unknown unknowns, right? It's what is the impact having on people that we, you know, like when social media came out, everyone's like, oh, it's great. I can share friends, you know, pictures with my friends and this and that, and it was great. And then it turned into like a political dunking contest,
Right.
and now it's a tool for getting people to hate each other who are, you know, they don't talk anymore and they're best friends or their family. Um, you know, that might have happened in the old days, but you get over it. Like now
Yeah.
it's just nonstop, like, you know, button of dopamine hit that just it just basically is messing with people. And that's, I don't want to say completely destroyed structures in our society, but it's definitely done a lot of damage. And, you know, we've been doing it for what, 15 years? Like, not that long. Um,
Right.
and so I think the thing I'm always aware of is like, what is, and I never got into social media because I just like, I don't know. It's just not my nature. Like
Sure.
I don't share. If I want to share with you, it's because you and I are having a conversation, not because I want to show everybody how awesome I am. Like, you know, it's not, but some people like that's part of who they are. But I worry about AI. Like, what is the damage going to be to how people operate? Or the other side of it is maybe it improves how everybody's doing things. I don't know. And I think
Right.
that's, I think one of the challenges is you get a lot of variation in potential outcomes with this from people like Eric Weinstein, who are talking about it's going to end the world, and you've got I forget the guy's name, the CEO of Replit, who's out there, who's talking about it's going to change the world and everything's perfect. And you know, as a you know a novice in this area and not an expert, let's put it that way, as a noob, I you know it's really hard to discern directionally how, you know, the impact of this, which could have
Right.
dramatic impacts on your business. So, how would you recommend business owners use this? You know, what's kind of a good mental model to use with this that they could integrate this without, you know, harming their business or trying to convert from a HVAC company into a AI HVAC company or whatever.
Right. Yeah. No,
You
great,
know?
great question. Yeah. Couple of things that I think will touch on what you're asking. So one, I think about the other technology advancements of any significance. I remember the big data stuff around 2007 and 8 when I was at Accenture. Um, I remember year 2000 stuff, not as well. I was younger, but still, we thought that was going to be the end of the world. Nobody was all that good at predicting whether technology advancements are going to be the end of the world, the greatest thing that ever happened to the world, somewhere in between. So I tend not to listen to them. I think that a lot of people their whole business is predicated on one of those extreme outcomes being accurate, and both, I think, monetarily, but also um, reputation wise. Like we wouldn't think of the AI folks as anything but monsters if we all knew that AI was going to put us into a matrix like state, right? If they thought that's where it was going, they wouldn't tell us either. So I kind of put all that on the shelf as conjecture. I think that as a business owner or even business manager, what's the rubric? I think you as a owner, manager of a P&L, constituent of respect wherever you are, need to understand how good AI is and the core things you deliver to your customers and stakeholders. Can it do 10%, 40%, 80%? What is it good at? What is it bad at? For a couple of reasons. I think if it's good at anything, you should be trying to figure out how to leverage it or hire people who can help you to get the best of what's there into your organization. We talked a lot about that on the lift call. I also think you have to know how good it is at your core stuff so you can call bull swing. So for instance, in my business, I have a financial audit accounting product. The people are already lying about having AI versions of it. I know some of my former vendors are their AI, and it's somebody in India or South Africa. I have no reason to go blast people, at being liar, but I know I've been on the boards of companies that have tried to create AI accounting products like the one that I produce. And so I know where it's at. So if somebody pops up today on LinkedIn, I've got the world's greatest AI quality of earning, I'm like, no, you don't, because I know. But if I hadn't invested the time over the past couple of years to be that close, I wouldn't know, and it would scare me more than it needs to. So I think the rubric is being informed. And I think the fear that should push you to be informed again, I don't want somebody half my age with a tool that I had the same access to that they did, kicking my butt in a couple of years because I want to put my head in the sand. And I still have 20 years of working life where I need to operate and make money. So I can't just ride off into the sunset. So I can't get usurped by something that's on the internet for free or cheap that I can work on, where I think the value of working with it is incremental relative to the time investment. I think that's the rubric. I tell my marketing and accounting teams that you need to be artificial intelligence aware. I am holding you accountable for understanding what artificial intelligence tools in your domain of excellence are out there and what they can do broadly. Does that mean I want you spending half your time on it? No, but I shouldn't be finding stuff before you do and you're the expert. Kind of how I think about it. If I was running a 100-person organization, I'd be telling my lieutenants the same thing. Now, do you have to be expert? Maybe not, but don't have a whole organization of 20 people and nobody knows, because our competitor has somebody who's paying attention, who's going to kick our butt.
Nice. Well, I know we've been talking a lot, Elliot, and we're going to wrap it up in a few minutes here, but tell the listeners a little bit more about what you do, because you have an interesting thing that you do with business owners, and it's funny. I haven't seen anyone else do it, and I think it's such a necessary thing. I wish I knew about this years ago when I started going down this path. But tell listeners a little bit about what you do.
Sure. So I operate at the nexus of first time buyers and sellers and the time when they're buying or selling their first business. So I think your audience may have more business owners. So I do, because private businesses don't have any operating standard, they have to produce financials. And yeah, taxes are cash basis. You should do accrual for the best understanding, but it's the wild west in how people present. If I want to buy, say, Kurt's business, for instance, and he's telling me that it's $1 million of cash flow or EBITDA, I would pay about 4 times that, so 4 million bucks. But how the heck do I know he's really doing a million in EBITDA and not 800,000 or heck 1.2 million? And I should close this deal tomorrow and maybe not do all the specific stuff because it's such a good deal. Well, you wouldn't know if you weren't a forensic accountant. And so that's where I come in. So sometimes I work for Kirk, the owner, and I say, hey, look, you want to go sell your business? You should do a sell side analysis to really put your numbers in verifiable, defensible um, arrangement so that any buyer, a private equity buyer, or Joe Schmo off the street can have a package of information that is accurate to the best degree. So when they say, hey, Kirk's got $1 million of EBITDA, they're like, how do you know? Okay, well, here's a third party independent accountant report called a quality of earnings. It's just like an audit. We spent money to have this done so you wouldn't have to wish or guess. Here's the good, the bad, and the ugly in the 30 to 40 page report. You should feel comfortable in the numbers now. Give me a full offer. And so I do that for sellers. I do the same thing for buyers. So if somebody's buying Kirk's business as an example, he says he's doing $1 million. You're not sure. You would hire me to go check those numbers to make sure they're accurate. On the buy side, which is when I work for buyers, which is probably 75% of my work, the other things that we've checked as a former deal professional is a business could have historically done $1 million in cash flow, but in a lot of businesses, probably like yours and mine, a big piece of that is who we are in our business. And so the likelihood that that cash flow will sustain without the Kurtz and the Elliots can be called into question. And so one way that I both differentiate against my competitors, but also deliver value is how likely is this cash flow that we've seen historically likely to sustain under new ownership with either an owner that's leaving in 3 months or is certainly less incentive to deliver on the hardest part of work. And so those are the main thing I do is called a quality of earnings. It's an audit like product that people use when they're buying or selling small businesses, so nobody's fooled about the financials. And then recently I started with some educational products. My mastermind is my biggest one where there's a lot of interest in this niche piece of the market and the returns that come from it. So you may want to get into it, but you haven't been educated in it. And the upside to you is worth more than the $20,000 fee that I charge for 6 months of hourly one-on-one time. And so you say, hey, look, I want an Ivy League education on how to buy a small business. Let me go to Elliott because he both has the educational piece. And then when I find something that I like, he can kick the tires and make sure I'm not getting screwed. And so it can be kind of a soup to nuts experience for folks who, as we've been talking about, may see this as a advantaged part of their next 10-year investment portfolio or strategy.
Nice. Yeah, I've noticed in the last 2 years, there's been a heavy increase in certain influencers, promoting the idea that people should be buying small businesses. And I find it fascinating. What I'm most fascinated is the fact that this didn't exist prior to 2 years ago, that the influence didn't. You think it was such a simple thing, but two people that have really made a name for themselves, and I think it's great. I'm not sure it's for everybody, but I like the fact that they're pitching this idea. Because I think everyone wants to invest in the next Google, but nobody wants to buy the dry cleaning shops that are just going to mint money year over year over year. Um, do you have a preference in terms of business type that from what you've seen and in general, from what people come to you with, or maybe the industry? I didn't say type, but
Well, here's what I say. The best ones are contractual ones that are monthly recurring. So like property management companies are ones that are contractual and monthly recurring that are great. But because they're great, they cost a lot. And so my first answer is kind of an obvious one and an expensive one. I think the best answer are industries that you understand or like. So like if your cousins are in it or your aunts and uncles, close friend is in landscaping. Well, now all of a sudden, if you go look at a landscaping company, you can hire someone like me to look at the numbers, but you can say, hey, cousins or aunts, why don't you come by this company for a day with me and kick the tires? You'll see stuff I won't see and help me make a good decision to kick this thing out. And I think that's competitive advantage. Or, man, you know what? I've always wanted to understand manufacturing. I'm a technical guy, I work with my hands. I really have wanted to understand manufacturing. And so I think another way to get competitive advantage is if you love an industry, want to understand it, have some historical basis to kind of be relevant in it. If you working in something that you like, I think you'll outpace people. And I think more than any kind of academic matrix, I think if you know people that are in it, or you have just a passion for it and it's profitable, not that stuff where part of the return is because you get to hang out with athletes or entertainers, then those are the where I see people have extraordinary success is when they have a leg up because they know it or a leg up because they're passionate about it. And I think the other piece that I would tell you to feel comfortable, you will not know for the first 3 to 6 months of your search what you like. Almost anyone won't. Looking at stuff that's directly related to what you think you'll like on day one will give you enough at bats to say, hey, I like change ups or I like fastballs low and away. And then you start really getting into it.
What um what do you think about franchises? Do you think they're worth considering or no?
Yes. In fact, I think a perfect risk balance in between real estate and a single operating business would be a franchise because there's an operating manual, there's an organization that has some impetus to help you. There's lots of other owners in different geographies that aren't really competing but understand how to win and lose. There's infrastructure, hiring manuals, that kind of stuff. I like franchises. I think I've had a couple of clients recently who started in my programs looking to buy an individual operating business and said, my body's not telling me that risk is okay. And they've gone to franchises and been very successful. And another area I'll say is non-food franchises. So people hear franchise and think Subway or Burger King, but there's street sweeping franchises, dry cleaning, home, health franchises. So there's other stuff.
All right, Elliot, we'll wrap it up here. Final thoughts from you, and where can people find more about you?
Yeah, I think just stay interested and stay diligent in this interesting market is my general advice. You can find me, Elliott Holland, if you Google it. My best socials are YouTube and LinkedIn, at Guardian Due Diligence on YouTube, and just my first name, last name on LinkedIn. I put a lot of time and energy into those socials, and I think if you're into the kind of stuff that I advise on, you'll enjoy the stuff that we talk about.
Awesome. Well, Elliot, appreciate you coming on the show. Thanks for joining us again, and as you know, we'll definitely have you back in the future.
Absolutely. Thanks for having me.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right, that was a great interview with Elliot. Really appreciated him coming on the show. Now we're into the panel portion of the show. We have our very own Barb Freeberg. Hey, Barb.
Hi, happy to be here. Loved the interview.
Glad to have you here. And we also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk, I'm also happy to be here. I'm looking forward to a good conversation. You guys talked about a lot of interesting things.
Yeah, this is gonna be a lot of fun. So, Barb, what were some of your takeaways from the interview?
My head is spinning. There were so many topics, but the main things that resonated with me were liquidity. You need to attend to liquidity. Private equity. You need to be very cautious with private equity. Markets today are extremely overvalued. It's very difficult to find someplace to invest today. Also, talked a little bit about keeping some cash on the side for when there is an opportunity, when assets go on sale. I thought the roll-ups idea was fascinating, putting together a bunch of businesses, trying to create some value and then selling them. But the overall takeaway is in 2026, end of February, how do you invest? How can you make money?
Yeah, no, I agree. Phil, what about you? What were some of your takeaways?
So I really like this conversation because it brought back a lot of memories and experiences that I had. It made me think a lot about them. When I worked for Deloitte, I worked on due diligence, which is kind of where some of this conversation started. And that was something that I did. In fact, I was part of the team that went in right after the KKR, RJR Nabisco merger closed. Like if you ever saw the or read the book Barbarians at the Gate, which I think they also made into a movie. I arrived in Atlanta basically the day that that book ends. So like a lot of the stuff that they talked about in there, I experienced. Um, you guys talked about accounting mergers and acquisitions. I worked for Deloitte and was involved when Touche Ross acquired Deloitte. And like, I'll never forget what the managing partner of Touche said to us at new managers school that year. He mentioned Howard Marks. I love Howard Marks. Like I read every one of his memos. I think he's brilliant, and he comes at things from a different way because he's coming at it from the fixed income side, oftentimes more than the stock side. I I have owned Berkshire Hathaway personally, and for clients, I've owned it for 25 to 30 years. I've been to the Berkshire meeting, and he talked about that experience. I mean, just a lot of things that I thought were really interesting. And then even private equity with all that's going on in the market right now, I mean, it's made that area very different. Like all the companies that are providing funding in private equity, a lot of them are having their own issues in the market now because AI is causing a lot of uncertainty.
Yeah, I want to follow up with you, Phil, a little bit. What was it like being in that office with, around the Barbarians of the Gate time frame? I mean, that must have been really
So
fascinating.
it really was. I'll tell you that it was in Atlanta and the offices were outfitted like no offices that I've ever seen. The cubicles that they had were made of mahogany wood. So when after that merger happened, they wanted to move everything to New Jersey, which is where Nabisco was headquartered. They couldn't sublet because nobody could really retrofit what they had because not only were they made of mahogany, but the offices and the cubes were tremendously large. And the office that I worked in, there were three or four of us that worked in this office at one point, and it wasn't like we were crowded. There was clearly room for four desks and space. And I remember one of the guys that I worked with, he had been in the Air Force, and we were not far from an Air Force base. And so if we wanted to take a break, we go, "Hey, Mike, what's that plane that's up there flying?" And he would go tell us, and then he'd tell us a little bit of the story. But it was interesting. I mean, they used to bring carts, because you think about it, they had RJR, right? So before I got there, they actually brought carts that had cigarettes on them if you wanted to get your free cigarettes, but they also had food. And so we worked long hours. I mean, I had we had 2 week time, our time sheets were for 2 weeks. And I had over 140 hours of time in 2 week periods. We worked a lot. So they'd bring out these carts. And so when I was there, the cigarettes were gone, which I didn't care about. I was actually glad that they were gone. But they had all kinds of Nabisco products and Lifesaver products and Del Monte and all these different things. So we would raid these carts when they came around because that's what we would use for sustenance because we were often working till 8 or 9 o'clock at night and then we would go get dinner, but to go from lunch till then was hard. So we would use those things, and planners was another thing. You get like nuts and dried fruit and things like that to help get you through the night. I mean, it was just a very different experience. And, like even from, never forget, you could do basically nobody cared about the expenses. I had a woman in my office that was responsible for our expenses. They called her the dragon. We called her the dragon lady because she was really tough. The partner called her and said, "Don't worry, whatever Phil puts in, just let it go." Because nobody worried. Like that was just so incidental to the whole project. But, you saw, like I was in the office where Ross Johnson sat. Like it was just, you don't see offices like that. Like I said, everything was mahogany. You don't see that kind of thing. Like normally, like the Deloitte office that I was in, you had like these steel things that had like a little bit of fabric on them, and that was what they used to set up the cubicles instead of this. It was just crazy, the opulence that you saw in that headquarters.
Yeah, people don't use mahogany anymore. Now they use marble. Yeah, I think they're trying to kill off the accountants, cigarettes and crappy food and and long hours. Yeah, that sounds like a recipe for success.
It had its plus side because I ended up school with a lot of debt because I had to put myself through school, and while I was there, I had no expenses because we stayed in the hotel and they fed us and everything else, and so that allowed me to put away the money that I needed to pay off that debt that I had graduated school with faster than I had originally thought I could.
Nice. So, Barb, let's well, I'm curious in your thoughts too. I mean, we obviously talked a lot about due diligence. How did this strike you, in regards to due diligence when you're looking at investments?
I loved that conversation because due diligence in whatever you put your money into is so important. And I'm going to take this down to a really micro level because a lot of people are investing in a lot of, say, even a mutual fund or an ETF that might be an actively managed fund, which, most of us just buy and sell and don't even think about it one way or the other. Oh, somebody said this was a good deal, so let me invest in it. I advise, look, I'm not a financial advisor, so I just advise people that ask me, not for money or anything, but I advise people that even when you are investing in a fund, you want to know what the risks are, what the fees are, what management fee are you paying to be in this fund? How does it work? What is it invested in? Do you understand it? Do you agree with it? So that's the micro level. But then let's talk about going into something like alternatives or crowdfunding. There's a lot of different, even private equity. Average investors can get into that. They promote a lot of investment opportunities that might not be on the public markets. And people just say, oh, they believe the marketing brochure. For example, one time I was looking into a legal funding fee. And this is a thing where you can invest in lawyers' cases. And when they pay off, like these big, I don't even, these big cases, the lawyers need the money up front because they do it on contingency. And so expecting a big payout at the end. Well, there are funds that you can invest in where you get a portion of those payouts. So I thought, wow, this is a really novel idea. This is really cool. But here's the due diligence part. So this this stuff is thick, it's wordy, it's complex. But I said, I'm not investing in this without understanding it. So I took the time, went through, read it all. What percentage might I get? What is my potential risk? And this is the most important thing when you're investing in any sort of private deal is what percentage do the owners or the creators of the deal what percent of their net worth is invested in it. Because if they're not invested in it, I don't want to be invested in it. And finally, what is the background of the people that are putting the deals together? If I see a deal, I look up the guy who set up the deal, and I say guy because most of them are guys, and I look at his background. If he's some guy that was a, fresh out of college, no experience to speak of, I'm like, why would I invest in a deal he's putting together? I have no reason to trust him. So due diligence from the small investor to the fund to the private equity to the alternative investments, you have to read the fine print because otherwise you don't know what you're in for.
Yeah, I would agree with that. I think so few people read the fine print and all this stuff. I think it's a tad bit unfortunate. Um, Phil, what about you? When you're, I mean, this is your background in due diligence. What's kind of your take on all this?
So when I was at Deloitte, the due diligence was a little bit different, right? Because we were getting in and looking at the financial statements and trying to verify that they were uh, accurate and that there weren't any shenanigans going on, and try to understand the profitability. And also, I used to do international tax work, and so I said when I worked on the RJR deal, like we went in and we were putting together strategies to where's the cash? Where can we get the cash? Because remember that a lot of these deals are so heavily funded with debt. So like in that case, we were looking at, like, I remember I had to hire a French interpreter because we had French financial statements. Also, you learn the difference that spoken, our regular language and our business language aren't the same. And so our translations weren't always as good as we'd like, but we were trying to figure out what the ability was to move money around. There were things like that. But when I do it from an analytical, from an investment perspective now, it really involves the things that Barb said, especially when you're looking at private deals, like understanding the ownership, what everybody's getting paid. I mean, even when you're investing in a newer company, you want to see that ownership has a stake. You want to see that they're right. Even if you're looking at a mutual fund, it's good to know how much of a stake ownership has. I mean, you should know those things. You should make sure you understand the fees. And a lot of these deals too that are private equity, your money's locked up for a period of time. You want to understand how long it's going to be locked up, what you can do to get out. I mean, I have a client that she inherited after her father died some uh, private private real estate venture, and can't get the money out. Like basically, she's waiting for them to go belly up, and the worst thing is she's still paying an ongoing fee every year to have this on the books because they haven't fully liquidated it yet. So you want to understand, and like that's not something that she could control because it's something her father did and that she inherited. But you want to understand all these things. Their experience really matters. Like Barb said, I don't think you want to. It's really hard to invest in something that the person doesn't have any experience in. I mean, sure, you're going to have some companies that start up. I mean, Facebook, Meta, whatever you want to call it, be an example, right? Like that company, Mark Zuckerberg started it as a college student and it became very successful. But that's the rarity. Most of the time, private equity investors are looking for people with experience. But I try when I'm looking at it in real depth. If I'm looking at a company, I want to understand. Look, I use my accounting roots. I want to understand what their accounting policy means. Some of the biggest issues that I found with companies relates to how they've done things like made changes in their accounting policy. Like it sounds really boring, but you can find a lot if you compare accounting policy footnotes. And like you've seen a lot of the big tech companies now, I periodically see articles talking about this, that they've taken the depreciation lives of their equipment, and they've lengthened it over time. Servers used to be 3 years. Now they're 4, 5, 6 years. We don't know if they're really going to last 6, but does that make a difference? Absolutely. I mean, think about it. If you spent $600 million on equipment that you used to depreciate over 3 years, that's $200 million of depreciation expense a year. If you now are doing it over 6, that's $100 million of depreciation expense a year. That makes a big difference when you're looking at financial statements and trying to understand cash flow and trying to understand what's going on. So you can find a lot. I mean, I find a lot too sometimes listening to management. And one of my favorite investing books is by Phil Fisher. It's called Common Stocks and Uncommon Profits. And he has his 10 points that you're supposed to look for in an investment from a not from a fund from a qualitative side. And I've listened to managers sometimes talk, and one of Fisher's points is to avoid highly promotional management teams. And I've had times when I was an oil and gas analyst, there were companies that I covered that I would hear their management and they'd say how we were so great at this and we're so great at that and we're so great at the other thing. And it would just make Fisher would ring in the back of my head, avoid highly promotional management teams. And usually that's right.
Yeah, it's interesting. I feel like they're all highly promotional now. I don't know. It's a bit
Much
of a
more than they
problem,
used to be.
right? Just really good at their job. But isn't that the CEO's job to be to be the head cheerleader? It's not really to do much else. It's just to be the head cheerleader, right?
But you
It,
know
it,
something, when you're talking about listening to conference calls, because I used to do that a lot when I was a portfolio manager and we invested in individual equities, and you can learn so much by what they're promising. Oh, these are our growth plans. And if you have half a brain, sometimes you can listen to them and say, this is realistic. This makes no sense. I would not bet on this. So, yeah, managers may have a certain degree of hyperbole, but if I'm investing any money in an individual stock, I want to understand what the growth prospects are. And one of the best ways to do that is to listen to those public investor calls after you've gone through all of the financials and fundamentals.
Yeah, it's funny. I have a lot of friends who do institutional research, and they're so polite when they are asking questions, and then afterwards they're like, "That is a pile of dog crap." Like if you're talking to them, but when you're there, you're like, "Are you falling for this? Like, why are you asking questions? This is clearly a waste of our time." And they ask their questions, and afterwards it was like, "What do you think?" Like, hell no. Like, okay, glad we're on the same page. You guys are too polite.
You
yeah, I
know,
mean,
and that reminds me of something else, which is whenever you're investing, whatever you are investing in, you have to look at multiples and multiples of assets, investments, deals, whatever, until you find one that is worth your dollars. And that's just reality. And when markets are overvalued like they are today, you may have to look at more and more and more. And I did want to say, I love the idea of, waiting for a drop, leaving some cash on the side because there will be a reversal at some point. And those of us who have some cash on the side are going to profit by buying these different assets when their prices are more reasonable.
and when you talk about like where management can be promotional and on when it matters more, like I can give you examples where like I can think of a CEO and you say, we have the lowest cost structure in the business. Well, the reason they had the lowest cost structure was because they used an accounting method that made it that way. If they used the other accounting method, it wouldn't have been because it allowed them to offset costs and positive cash that came in. They said they had the best, um, they were better at forecasting weather than anybody else. I think they had this team of people and made it like they could, their hedging team was the best in the industry. Like you can't be the best at all those things. And it's just, and a lot of those things we know you can't forecast. So to say that just lacks credibility. And then, you talk about the level of detail. I remember one company, it was an oil field services company that I covered, and I was at their analyst meeting, and I asked him some questions related to some things. It's the cash conversion cycle, which basically looks at um, how long it takes you to buy a raw material, take it and turn it into a finished good, sell it, and then collect the revenue. So like that's day sales of inventory, day sales of accounts receivable, and day sales of payables. And like you add the first two and subtract the payables from it to get a number. And their number had trended downwards. And I asked the CFO about that. He's like, Phil, I have a whole book of stuff here for on this. And he says, you're the first analyst that ever asked me about it. Because like stuff like that, although it matters, right? Because it really talks about how much attention, like if you pay more attention to that, you need less outside funding because you're collecting faster and you're able to elongate some of your payments too. And you're taking your inventory and you're managing it better. Like that's really skill and something that you can do. And a lot of companies don't pay attention to it. And so like if I'm looking at companies in an industry, I'll look and see how they compare on that metric. But it was amazing to me when he said to me, "You're the first analyst that ever asked me."
Yeah, Phil, you're geeking out on this way too much. You know, you're the reason why people don't do fundamental analysis anymore. It's just too darn hard. I mean, seriously. I mean, just listen to Phil for a few minutes and talk. I mean, he loves this stuff. Obviously, he's very in the weeds in it, and he's very passionate about it. But you know, think about a guy like Phil who's got this level of depth and intellect and background, and compare that to everybody else. There's a lot of smart people out there, but they're lazy. I mean, Wall Street is filled with lazy smart people. And they're just looking, well, what's Phil doing? Like they're like, well, I could do the work. I could just ask Phil. Like it's like cheating on your neighbor. I mean, at the end of the day, you know, the problem is the kind of stuff that Phil and Barb are talking about. It is necessary for investing to work, and yet no one seems to care because it doesn't seem to matter, at least at the moment, right? And that changes from time to time, but. I think the last time this mattered was what, the early aughts, when people actually cared about fundamental analysis. I mean, it seems to be maybe it's starting to come in back into play, but I don't think so. Not when you have all the money sloshing around that we have. And I think until that dissipates, you're going to have PEs in the 30s to 50s, and who knows, maybe even higher. What does it matter anymore if you're buying a stock for a 50 PE because well it's going up, we'll just keep buying it. So I think that's one of the challenges of all this is that, you know, does value investing even exist anymore when, you know, I forget what Walmart is, was like a 30, 20 or 30 PE or something crazy. Like, okay, I guess. Um, or Apple that hasn't grown revenues or profits in like 3.5 years, and yet they have, what do they have, like a 30 some odd PE? I mean, you know, not knocking these companies, just like the valuation's crazy, and people don't seem to care. So I think it's interesting. It's an extremely valuable skill set to do all of this. It's probably more valuable on the private side, don't you think? I don't know if either one of you want to comment on the private side. Go ahead, Phil. Do you think it's more
Uh,
valuable on the private side now than the public?
it probably is because for two reasons. One, you can have more of an information advantage on the private side, right? Because there's so much out there on the public side. I guess where you can still sometimes separate yourself on the public side, if you're the only one looking at it and it allows you to find something that everybody else overlooked because of what you just said, Kirk, that, you know, it's going up and I'm going to buy it because it's going to keep going up because everybody else is buying it, right? But on the private side, information is much harder to come by. So asking the right questions I think, can make more of a difference.
Yeah, I would agree with that. I think a lot of this comes down to asking the right questions and, you know, pushing people, right? If you're asking questions, you got to push them. It's not about making friends, it's about getting the answer. And sometimes you got to be a little pushy to get the answer if they're not answering it for you, which CEOs tend to do, right? You ask a good question, then they completely ignore it. Um, well, as we kind of get close to wrapping up here, Barb, final thoughts from you on this.
We covered so much, but my final thought is that over the decades and decades and really hundreds of years of market data that we have, there have always been periods of ups and downs in investment markets, be it in debt, in equity, in whatever. We are really trending up now for a long, 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 long time. Albeit we had a little blip where we had a downdraft in 2022, but that was it really since 2008 to 2011. So I'd like those of you investors out there to consider that at some point we will have a reversal. We don't know when, we don't know how much, but the smart investors leave a little bit of cash on the side so that when we do have that reversal, you can, even though it's scary, you can pick up assets that are cheaper, that are on sale, and thereby set up your future for greater returns going forward. I am Barbara Friedberg. You can find me on YouTube and at Barbara Friedberg Personal Finance.
Well, appreciate you coming on, Barb. Thanks for coming on. And Phil, final thoughts from you.
So I think it's the idea of due diligence or understanding is really what you're investing in is really important. You don't always have to have the deepest knowledge. I mean, that depends on your level of interest and how you invest, right? That's why a lot of people end up investing passively too. Uh, it, during the interview, Elliott mentioned Howard Marks, and his firm is Oak Tree Capital, and he puts out memos. They're not at regular intervals, but I recommend you sign up for them. He's a good example. I know, Kirk, you've mentioned the idea of second level thinking on other times that we've been on this podcast. And like that's one of his big things. It's just thinking about not just what everybody sees, but what lies underneath. I'm Phil Weiss, and I know experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. You can visit our website at Apprise Wealth, that's APPRISE wealth.com to read and sign up for our weekly blog. Thanks for having me on today, Kirk.
Yeah, thanks for coming on. Thank you both.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.